I've made most of the money I've made in my life by being a contrarian, by buying hate. And the gold and silver markets aren't hated anymore. Even the platinum and palladium markets aren't hated. People are still bored by it, maybe until the last 2 weeks, but it's not hated. Oil is hated, and I'm very attracted to that.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today, we welcome back Rick Rule, our resident commodities guru and mentor in the space. We're going to talk gold, silver, platinum, palladium, and oil. Premium subscribers, be sure to check your inbox. Rick and I will go into some of the individual stocks in our portfolio for maximum upside. That is available only for you. Rick, thank you for coming back on the show.
A pleasure, Steve. Thank you for having me back, and thank you for the series, which I think has delivered value to your subscribers for years now.
Yes, you're welcome. Thank you for all your work in the Rule classroom, for letting me in there. We had an amazing boot camp. That was a lot of fun. I felt like it was a really nice cherry on top of the sundae, rounding out with the juniors, and well timed too.
It was remarkably well timed. As we talked about in the boot camp, I had thought when we scheduled this boot camp that the information in this boot camp would be useful a year from now. I hadn't understood that the progression of the bull market in terms of time was such that it was as topical as it was. And I share your enthusiasm with the content. I thought that the range of speakers we had, from John Hathaway, the Dean of Institutional Gold Investors, I would suggest, through Adrian Day, one of the leading independents for the last 45 years and a personal friend of mine since 1987. Jonathan Goodman, who I think does probably the best buy-side due diligence on the planet. Lobo Tigre, who is uniquely positioned after 25 years of learning to talk about the juniors. I think they conspired together to do a spectacular job. And Naked Commercial, the information in the boot camp was timeless, although it is appropriate to today. The recordings of that boot camp are available, and they come with a full money-back guarantee. If you think for any reason that you didn't get value for money, we'll give you your money back. And as you know, Steve, that offer, money-back guarantee, has been in place for 40 years on the investor education product offered by me. And over 40 years, we have had to refund about 1/10% of the tuitions that we've charged.
Yeah, it was a lot of fun. I'll put a link down below. If you guys missed it, you can check it out. I highly recommend it. Also coming up in the Rule Classroom, we've got Adrian Day this month. We have a Q&A today, so that will have happened after this with you and Albert. And Joe Mazumdar, our resident geologist. I'm going to be doing a Q&A with you at the end of the month, day before Halloween. So yeah, a lot of stuff. I'm very excited, and it's a lot of fun to be a part of it. A lot of smart students in there too.
It will get to the place, believe me, where the contributions of the students exceed the contributions of the teachers. I've learned at my Boca conference that the idea that all of the information in the room, all of the intelligence in the room, is at the dais and distributed to the audience is wrong. There is much more accumulated wisdom in the audience, and that is the case at the Rule Classroom. And it's beginning to be expressed at the Rule Classroom. In the discussion groups, I mean, sure, there is always the discussion, what do you think about moves past your minds, right? That's always going to be there. But the truth is that there are beginning to be people who are utilizing the tools of the classroom, Introduction to Natural Resource Investing as an example, and posting their own valuation work and having discussions with other folks at the classroom who are imposing the same discipline. The progression of the discussion groups, the progression of the community at the Rule Classroom is exciting and gratifying to me. It's what we created the Rule Classroom to be.
Yeah, a lot of fun. I want to go into, speaking of the Gold Bootcamp, I'm going to share my screen here. I'll take a look at gold itself. So we've had a really nice spike up here. We've come to the nice round number of $4,000 per ounce. What are you thinking here, Rick? Are we in for a? I mean, looking at the charts here, I can't help but think like everything screams not necessarily overvalued, but just overbought, on a shorter term time basis? What are you thinking here for gold?
I'll defer to you, Steve. I don't do technical analysis. It's not something that I do. I do absolute and relative value. My experience has been when you see a market with the enthusiasm of the market that we're in, that there are dangers of it being overbought. You have sort of a perfect storm of opinion right now. That chart and overlay that with very high profile investors urging people to buy gold and the revision of the opinions out of the investment banks, as an example, saying that the 60-40 portfolio is now becoming 60-20-20. People increasing their recommended weightings of gold from 0 to 20. All of that hitting simultaneously suggests that investors and savers should be prepared for an air pocket, whether or not it occurs. In the near term, prices are set by the balance between buyers and sellers. And right now, there's all buyers and no sellers. In physical gold, we have continued aggressive buying by the central banks, which is the new factor in today's markets. They were absent prior bull markets. But it wasn't really till 15, 18 weeks ago, measured by the inflow of capital, retail capital, into ETFs, that we had public participation in the gold market. So now we have continued central bank buying and retail buying, which I think is what is responsible for that chart going parabolic. Okay. One could say that the parabolic move it reflects built-up tensions from the fact that gold didn't move parabolically for a very long time, despite the fact that the challenges in the assets that gold competes with, the euro, the British pound, the renminbi, the dollars, were in place. So one could say that what the chart is doing is playing catch up from at least a decade, but more likely 2 decades of undervaluation. That notwithstanding, as you suggest, there is some fear in a hockey stick chart. The backside of a hockey stick is frequently as steep as the upside was.
Yeah. Usually charts don't move up in a straight line like that. Right. Another one that's been moving up in a straight line here. So here's the silver futures price. Right. Today, the futures got up just a couple pennies shy of $50. This is the spot price. The spot price today got up over 51. So we're seeing a little bit, well, at least we were before I hit record here, we were seeing backwardation. In other words, the spot price was cheaper than the futures price. Is there any forecasting in that, or do you watch those spreads at all?
There may be forecasting, but I'm not smart enough to see it.
Okay.
What I can tell you is this, and we've discussed this before. In 50 years in these markets, I've been through 3 bull markets, precious metals bull markets. And at some period of time, what happens is that when the precious metals narrative establishes enough momentum in gold, that the generalist investor comes into the precious metals space. When the generalist investor comes into the space, market leadership switches from gold to silver. It may be that the price action that we've observed in the last 4 weeks is suggesting that that crossover period is happening now. I don't know. I'm not that smart. I would again, Steve, frankly defer to you in terms of the divergence between gold and silver prices and the acceptance, speculative acceptance of silver among generalist investors. The relative importance of things like contango or backwardation is not something that I'm well enough versed with to offer an opinion. Okay.
All right. Yeah, seeing a lot of silver and gold equities shoot the moon here. Pretty exciting. Thank you for all your advice over the years of getting into these things and writing this on the way up. It's been a lot of fun. I also want to hit on a couple other metals that have been spiking up, and you got us into these shoot, probably 2, 3 years ago, and that is platinum and palladium. So here's the platinum chart. Just a nice, another little spike up here. Here is the palladium chart. Last time we were on, we were joking that it looks like Russia has finally run out. Do you have any new insight into that?
Well, that was speculation on my part. Sadly, Mr. Putin is not on my speed dial, nor am I on his. So I have no evidence to suggest that that's true. I do remember an earlier period in history, the beginning of the decade of the 90s, the last time the Russians were in dire need of cash, as they are today. And Russia met that need by emptying her cupboards of whatever she had to sell, which included prominently nickel, platinum, and palladium. Those elements moved when Russian supply ended, when the Russian cupboards were bare. It may be that we are seeing that same thing. It may also be that the price spikes that we're seeing now are just the emergence of speculative bids in a market that hasn't caught a speculative bid for many years. Remember, the prices on the margin are set by the delta between buyers and sellers. And for a very long time, we've had no buyers. Towards the end of a bear market, what happens is the sellers are exhausted. They've sold. And buyers reemerge into a vacuum. So it could be that that's what we're seeing. Rather than the end of dishoarding, we are seeing the end of a bear market where the sellers have gone to seller's heaven. And the buyers, however sparse they may be, your volume numbers actually suggest they're not that sparse, are coming into a market where there's no supply. Either of those circumstances, or more likely than either, a combination of those two circumstances are probably what's responsible for that lovely chart.
Okay. Okay. Also want to talk about oil. I feel like in your last boot camp, you gave the caveat that, yeah, gold and silver are doing amazing, but personally, you've taken some profits and you've started to move those into oil. Here's the oil chart, and crude oil is still sitting around $60 a barrel. There it is, sitting at 61.50 today. Looking to me like it's going to get cheaper, just kind of like you describe it as like the EKG of a approaching dead person here. I also can't, how can I say this? The XLE chart. So this is an oil ETF. Its biggest holdings are Exxon and Chevron are the top two, and then ConocoPhillips. Between those three, I think it makes up like 45% of the ETF. So kind of a real nice one-stop shop for your beta investor to just kind of grab some oil in the sector here. And I can't articulate how much I like this chart and how bullish it looks just with all the moving averages. I mean, it looks like God's hand itself is about to scoop the price action of this up. Maybe could you go into just your overall thesis for the oil market right now and why you're rotating capital?
Yeah, absolutely. I've made most of the money I've made in my life by being a contrarian, by buying hate. And the gold and silver markets aren't hated anymore. Even the platinum and palladium markets aren't hated. People are still bored by it, maybe until the last 2 weeks, but it's not hated. Oil is hated. And I'm very attracted to that. And the industry has referenced that hatred by deferring sustaining capital investments. Specifically, the International Energy Agency suggests that the oil industry, including state-controlled firms, has deferred $2 billion a day in sustaining capital investments. That doesn't necessarily impact your ability to produce in 2025 or 2026, but it does impair your ability to produce in 2027 and 2028. And so I think the story that nobody is looking at is oil supply. That oil supply shortage could be overcome, at least partially, if you have peace in the Ukraine and Russian oil can come back into market. The fundamental that mutes that response is the fact that for 3 years, The greatest sinner in terms of deferred sustaining capital investment in the oil business has been Russia. They've been spending money on tanks and bombs and planes as opposed to sustaining capital investments. So their ability to impact supply for 2 or 3 or 4 years is going to be muted. Meanwhile, even at an oil price, $60 a barrel, which will be impacted as a consequence of underinvestment, the high quality oil companies and the mid quality companies are selling at a discount to their net present value at $60 oil. This is an unusual circumstance. I think in a nominal sense, in a US dollar price sense, that the oil price likely over 3 years goes up 25, 30, or 40%. And I think that a whole basket of oil producers is selling at a substantial discount to their net present value at $60. That's pretty attractive to me. And I note too, in my life, I have made a lot of money doing what the market makes easy. If the market has a preponderance of buyers and there's no sellers, I try to be a seller. I give the market what it wants, which is to say sell side liquidity. If the market has a dearth of buyers and lots of sellers, I try to be a buyer. I try to do what's easy. I'll give you an anecdote, Steve. Years ago, when I still ran on a daily basis, Global Resource Investments, before I sold it to Sprott, I'd walk in the cage at the end of every day. And if buy tickets overwhelmed sell tickets 4 or 5 to 1, that is to say, if there was a stupid preponderance of buyers, I'd be a seller the next day. If sell tickets overwhelmed buy tickets 4 or 5 to 1, I'd go the opposite the next day. And I made really admirable amounts of money with no technology more sophisticated than being a buyer when others were sellers, or sellers when others are buyers. What I've particularly found in my life is that when the best of the best in a category is demonstrably cheap, where I don't have to go down the quality scale or the market cap scale to attract value, that means to me that the sector's cheap. I look at the bellwether oil stock, Exxon. I look at the fact that while others are deferring sustaining capital investments, they're making them. While other companies are returning capital to shareholders because they can't grow, Exxon is buying Pioneer for $60 billion. I look at a company with a balanced success upstream and downstream and a 30-year track record for the efficient allocation of capital. And I look at a company with an emerging discovery in Guyana that is so large that it moves the dial on Exxon. And I say, this is attractive. I run the valuations on Exxon on a net present value basis with a tail for that period of net present value, which exceeds the discount. And I think Exxon is selling for perhaps half what it's worth at $60 oil. I believe that the oil price increases by 20 or 30 or 40% over 3 or 4 years. That suggests to me that Exxon is selling for perhaps a quarter of what I believe it might be worth in 2030. The finest company in the sector selling at 25% of my target valuation 5 years out. That's extremely attractive to me. I made my money in the oil business backing exploration and production businesses, $50 million businesses, $100 million businesses, $200 million businesses. And believe me, I deserve to make the money because I had to work hard and I had to take real risks. Buying defaulted junk bonds in the oil and gas business, doing the hardcore credit analysis. The idea that I can buy the best of the best with a fortress-like balance sheet, generating embarrassing amounts of cash at an oil price that is below the marginal break even for many state-owned firms, is extraordinarily attractive to me. I don't have to do a lot of work. Doesn't get much better than that for me. You and I talked 3 or 4 years ago about the idea in the gold business that new investors should own Franco, Wheaton, and Agnico, that they shouldn't worry about buying any companies that weren't among the best of the best. That was a real simple 2 year, 3 year, what, double, triple?
Yeah, over a double.
You didn't need to come down into the penny dreadfuls. You didn't need to buy Amalgamated Moose Pasture or Consolidated Orangutan. You could buy the best of the best. And that's where we are in the oil business today.
Okay. Okay. So you've made a habit of buying stocks or sectors that are hated. Gold and silver are not hated anymore. They're moving into loved.
Right.
Oil is still hated. One of your base cases for this is they're deferring investing capital of $2 billion a day. And basically that's money that would be going into exploring and looking for more oil and gas. Is that correct?
Developing, not just exploring.
Okay.
In the U.S. shale basins, as an example, the big swing producer in the world, the rig count's off by almost 70%. You don't need to explore for shale oil. You just need to drill it and develop it. At $60 oil, there's less incentive. The industry, in the conjunction of current technologies, is also running out of grade A locations. We've drilled them. If technology improves, don't get me wrong, locations that are B grade locations will become A grade locations. But in the conjunction of technologies that exist today, we're running low on grade A locations, and our willingness to drill them to generate the production that will be necessary to sustain our levels of production 2 years out and 3 years out isn't taking place.
Okay. Okay. And because of that, there's no shortage of oil. There's plenty of oil there. They just haven't put in the infrastructure or spent the money to get that out a few years from now. So that's probably going to create some type of squeeze, which is kind of what you're betting on.
There's a couple of things that could go. Yeah, yes. Direct answer, yes. What can go wrong with that thesis is something we may be seeing today. A global synchronized recession, even if you have a shortage in supply, could generate a shortage in demand too. And I think the softness that we're seeing in the oil quote, and also I think you're seeing expressed in the copper market, where copper prices are up 5% on a 7% reduction in global supply from things like Grasberg and Kamoa and Cobre Panama. The response in the copper business to taking 77%, pardon me, of world supply offline suggests to me that the global economy is much weaker than people think it is. That current demand for industrial materials, including oil, natural gas, and copper, is much softer than the headline economic statistics would suggest. I'm no economist. I just have no other explanation for a production hiatus in copper and a flatline production in oil not having more impact on price, particularly when nominal pricing should be being impacted by the declining purchasing power of the US dollar, the currency that those products are denominated in on a global basis.
That was going to be my follow-up question. Basically, what is your bearish case? And that you're saying is we could be in a worldwide economic recession, and that would explain the softness in not only oil, but also copper.
5 years out, a bearish case could develop for oil through the advancements in technology. The United States went from being the largest oil importer in the world to being an oil and gas exporter as a consequence of several technologies: horizontal drilling, measurement while drilling, 3- and 4-fold seismic, and fracturing. Advancements in particular in production technologies, advancements in technologies that would allow us to remove more of the oil and gas in place could have the impact of lowering the cost or increasing the certainty of producing oil. And technology could mute some of the upside that I see in the oil business over 5 years. It isn't going to happen in 2 years, but it could certainly happen in 5 years. I remember, as an example, Cheniere Energy came to exist because conventional natural gas technology meant that the United States was going to be a gas importer over time. And Cheniere's original premise was that they were going to build deliquification facilities so that they could import gas from places like Russia and Algeria and use it in the United States. The convergence of those technologies meant that the United States generated a superb surplus of natural gas. And those facilities, which were meant to import natural gas, became critical exporters of natural gas as a consequence of technology. That could happen. I'm not smart enough to tell you that it will happen.
Okay, are you familiar with Doomberg? He's
I am.
okay.
I'm a fan.
Okay. Yeah, I just interviewed him recently, and one of his arguments for oil was he was saying that oil is basically oil companies are deflationary machines with increasing technology. They over time drive the price of oil down. This is the chart of gold divided by WTI. And
Right.
so one of his arguments was that, if you take real money, gold, and use it to price a barrel of oil, over time, you kind of get a chart that's going from the lower left to the top right, which is suggesting that the price of oil in real money is getting cheaper over time. Do you concur with that, or are you basically betting on in the next 5 years or so the chart doing that? Although in the long run, it is going to continue that up.
Yes and yes. I guess Duberg is a better economist than I. Let's get this part straight. I don't purport to be. I'm really a credit analyst. I have been widely quoted, including on your show, as suggesting that the real value of the U.S. dollar declines at 7 or 8% compounded for a very long time. And that the US dollar loses 75% of its purchasing power in the next 10 years. That would suggest that the nominal price of oil, priced in US dollars, has substantial upside if for no other reason that the dollar buys less.
Yeah, it's been inflated a lot. Yeah.
Some of the oil price escalation that we saw in the decade of the 70s didn't have to do with the oil embargo. It had to do with the fact that the US dollar declined in purchasing power by 75% over the decade of the 1970s, which would account for a fourfold increase in the oil price. In other words, half the price escalation in oil likely occurred in the decade of the 70s as a consequence of the declining purchasing power of the US dollar. So what Doomberg says there, I think is very true. I don't want to compete with him in business economics because I can't. He's better at it than I. I look to things like free cash generation at $60 oil and the impact of sustaining capital investments or lack of sustaining capital investments on production 2 or 3 years hence. I think there's room to overlay our disciplines, and I think you did that fairly well.
Okay, thank you. As far as the Middle East, Saudi Arabia, OPEC Plus, could these guys turn on some oil like a spigot and flood the market if they wanted to? Or
Not in the near term. The Saudis have an astonishing inventory of shale and basin-centric opportunities, which they haven't had to access. They have this wonderful thing called Gawar, which is basically like drilling into a tanker. Gawar is now in terminal decline. It has a lot of life left, but the Saudis have not had to do in Saudi geology what we have done in places like the Permian. And when they do, the current Saudi reserves, let's just say there's no reason to have a decline in Saudi for a very long time. This will not be cheap oil, though. Producing oil by slant drilling into an oil tanker is substantially cheaper than 4-mile long horizontal legs, multi-stage fracturing. The oil production increases that you will see out of the Gulf 10 years from now, 20 years from now, 30 years from now will not be low cost oil.
Okay. Okay. All right. It's there and there's a lot of it, but it's not
It
cheap.
is it is really, really, really there. In the US, we often get excited about shale sequences that are 30 or 40 meters thick. Some of the shale sequences in Saudi are 1,000 meters thick,
Wow.
which suggest that you could have the impact of drilling a horizontal hole with a vertical hole. If you allow yourself to fantasize.
Yeah. Um, California. Maybe I'm just partial to this because I live here. It seems like Gavin Newsom, our hero, is just hammering out approval permits. I got to believe he probably has his eye on 2028. Any thoughts? Is there going to be any impact in the near term on that? I mean, we have a plethora of oil off the coast here in California. What do you see happening there?
There is a lot of oil in the Santa Barbara Channel, as an example. The Southern California offshore fields have not been explored by they haven't been explored since the 60s. Similarly, I would suggest, I'll go out on a limb, I would suggest that the LA Basin onshore has 1 billion recoverable barrels that haven't been discovered.
Oh,
I mean, it's small, but it's a deep, oily basin. And it hasn't been explored by any modern technology ever. Then you go to the west side of Kern, things like Beldridge, Midway Sunset, those wonderful fields. Governor Newsom, in his wisdom, refused to permit new wells. There's a permitting backlog in Kern County alone that exceeds 2,000 wells. That oil doesn't need to be discovered. You just need to turn on the plumbing. Will California production make a difference to the world? Not at all. It's a pimple on an elephant's behind. But would that production make a difference to the state of California? Gasoline prices, jobs, sadly, tax revenues? Yes. California also has amazing talent in the oil and gas business. One of the best independent thinkers in the oil and gas business in the world is a guy named Flores, who cut his teeth on the Gulf Coast and is now involved in the California offshore. He's there because the assets are selling at a discount as a consequence of political risk, and because he says that the upside in exploring for oil and gas offshore California resembles the upside that was present in the Gulf of Mexico in the 1990s. I have a personal friend who is a very large producer of oil in the LA Basin, a private guy. And, he's done things like do Vibrasize, which is to say truck-mounted seismic technology on places like Crenshaw Boulevard in South LA.
For anyone that doesn't know, that is in the heart of LA.
he's a very, very, very innovative guy. And when he talks about the fact that there are vast amounts of conventionally available oil in the LA Basin, if he would merely be permitted to drill, he knows whereof he speaks. And then one needs to remember that in more permissive regulatory climates, Kern County in California was the single largest producing county in the United States. A county that, on a countywide basis, outproduced anything in Texas or New Mexico or Louisiana or Oklahoma. The geology hasn't changed. Occidental Petroleum, pretty good oil company, estimated that their own acreage in terms of advanced extraction, shale and basin-centric extraction, had probable reserves exceeding 500 million barrels. It waits on the governor to say the state of California might be able to use that tax revenue.
Yeah. Okay. All right. So any fears of Governor Newsom or Governor Gruesome blowing up the oil bet, like you said, it's a pimple on an elephant's behind. It's not going to happen.
Sadly, I think it's a probability
Okay.
as opposed to a possibility. I think I think he's a uniquely dangerous politician. He would like to take his failures in California national, uh, and he seems to be, ironically, as a consequence of oil money, the Gettys, uh, the odds-on favorite to get the Democratic nomination for the presidency. Who knows what damage he could do? Maybe a bullet train from Point Barrow, Alaska to Ajo, Arizona, or something like that. A highly expensive train from nothing, from nowhere to nothing. Um, it's an astonishment to me.
Yeah. Yeah. I can't believe he won the recall by 2 out of 3 votes, but the man did. Um, okay, wrapping up here, we're going to go over some specific companies in the premium update, so stay tuned for that. Um, Wrapping up here, what single assumption, given the oil bet, if proven wrong, would cause you to reverse your long-term bullish stance on hydrocarbons?
Nothing. Uh, Improvements in technology would cause me to alter my price forecasts,
Okay.
or a synchronized global recession or depression would lengthen the time necessary for me to be right. I don't think it changes the equation from a when answer to an if answer, but it does delay it. Many of your audience still thinks that their time preference matters, which is to say that they'd like to be right in the near term rather than long term. I would too, but I've come to realize after 72 years that that's not on offer. And I believe that asking myself investment questions where the answer necessarily begins with when as opposed to if exposes me to a high quality question. And I'm very comfortable with my oil and gas bet. It's interesting when I say this on some channels and I look at the discussion groups that follow. And people say, well, he's 72 years of age. Of course he would believe that. He's not paying attention to the future, which is alternative energies. And I would say to people, I understand your narrative around that. They've been well explained by that noted energy physicist, Greta Thunberg. Uh, Over 40 years, we have now invested $5 trillion in alternative energies, which is a lot of money. And we've made real breakthroughs. And the market share of fossil fuels has declined from a high of 83% 40 years ago to a low of 81% today. The suggestions made by Governor Gruesome and Mr. Biden and Angela Merkel and Justin Trudeau that the sunset of the oil industry is upon us and that the half-life of oil demand is 2030, those are the bleedings of people who can't do arithmetic.
Okay. Awesome. Well, thank you very much, Rick. We'll put links down to the boot camp for anyone that missed it down below. Links to the Rule Classroom, the Rule Classroom Plus, and congratulations on Battle Bank. You're getting closer and closer here to the finish line. So, or I guess the finish line for you, the starting line for everyone else. Any final thoughts?
Well, two more, frankly. Anybody who cares what I think about natural resources can find out personally by going to my other website, ruleinvestmentmedia.com. If you go there and list your natural resource stocks, I'll rank them for free. Of course, because it's for free, that comes with a full money-back guarantee. Ruleinvestmentmedia.com. List your natural resource stocks. As always, no crypto, no pot stocks, no tech stocks. Free, which is a really good deal. As to Battle Bank, as you suggest, our transaction acquiring a bank in upstate Wisconsin has closed. We are in the local banking business. We will be in the national banking business in early January after a very, very, very long gestation period. I'm delighted to say that our wait list is now 18,000 people long, with 3/4 of them knowing enough about the bank's prospective services that they've specified on their wait list applications what services the bank has that are of interest to them. Anyone in your audience, Steve, who hasn't done that, I would urge them to do it. If they're interested in receiving interest, as an example, there are $3 trillion on deposit in the United States in non-interest bearing accounts. Maybe Governor Gruesome has one. People who are bad at math. We pay interest on your savings, even if you decide to write checks against it. If you decide that you might want to save in currencies outside the US dollar, given currency turbulence around the world, I think this is a wonderful time to do that. At Battle Bank, you can save in 20 currencies, not merely the US dollar, although certainly we encourage US dollar savings as well. If you would like your IRA to be your IRA, not a receptacle for Wall Street's products and services, if you'd like to buy a duplex or a triplex or an Airbnb, if you'd like to invest in private equity, gold, crypto, a franchise, whatever in your IRA, you can do that at Battle Bank or in a solo 140 or in a solo 401k. If you believe, as I believe, that precious metals are a great store of wealth, but particularly where if you need occasional access to the capital that you have tied up in precious metals without selling them, Battle Bank, unlike every other bank in the country, believes that precious metals are good security. We will establish a metals equity line of credit, similar to a home equity line of credit, in effect, access to a margin account secured by your gold and silver. A wonderful way to have your cake and eat it too. If that is of interest to you, and it should be of interest to anybody who's listening to In It to Win It, go to battlebank.com, get on the wait list.
We will put all those links down below. And yes, we are all interested in interest, Rick. Thank you for coming back on the show.
Always a pleasure.
Thank you for tuning in today. If you enjoyed this conversation, we went even deeper in a special interview exclusively for premium Substack subscribers, where Rick reviewed our oil companies in our premium portfolio. If you want access to that, plus weekly updates of the stocks I'm buying and selling with real-time trade alerts, head over to Substack and join us. The link is down below in the description, or go to stevebartonmoney.com and sign up there. If you're already a premium subscriber, check your inbox. The next video with Rick is waiting for you. Thank you so much for your support. Have a wonderful rest of your day.